Hello everyone, welcome back to our channel. Today, we're going to talk about a crucial topic that can make or break your financial future: building an investment portfolio. We'll delve into the concepts of asset allocation and diversification strategies. So, let's get started. Building a diversified investment portfolio is crucial for achieving your long-term financial goals, whether that's saving for retirement, a down payment on a house, or your child's education. In this video, I'll explain the key principles of asset allocation and diversification, and provide strategies for constructing a well-rounded portfolio. First, let's define a few key terms. Asset allocation refers to how you divide your investments across different asset classes like stocks, bonds, and cash. Diversification is the practice of spreading your investments across different sectors, industries, and geographic regions to manage risk. These two concepts work hand in hand to create an investment portfolio that is positioned for growth while also protecting against volatility. Asset allocation. The three main asset classes are stocks, bonds, and cash equivalents. Stocks, also known as equities, generally offer the highest potential returns but also come with the greatest risk of short-term losses. Bonds, on the other hand, are debt instruments that provide more stable and predictable income, but lower long-term growth potential. Cash and cash equivalents like savings accounts and money market funds have very low risk but also the lowest returns. Your ideal asset allocation will depend on your investment time horizon and risk tolerance. For example, if you're saving for retirement 20 years from now, you may want a more aggressive portfolio weighted heavily towards stocks. But if you're saving for a down payment in the next 5 years, you'll likely want a more conservative mix with a larger allocation to bonds and cash. A common starting point for many investors is a 60-40 stock-bond split. This balanced portfolio is designed to capture equity market growth while also providing stability from the bond allocation. More aggressive investors may lean towards an 80-20 or even 90-10 stocks-bonds mix. And conservative investors focused on capital preservation may opt for a 40-60 or 30-70 stocks-bonds split. It's important to note that your asset allocation may need to evolve over time as you get closer to your investment goals. As you approach retirement, for instance, you may want to gradually shift towards a more conservative mix to preserve your hard-earned capital. Diversification strategies. Now that we've covered asset allocation, let's talk about diversification, the practice of not putting all your eggs in one basket. Diversification helps manage risk by ensuring your portfolio isn't overly exposed to any single investment, sector, or region. Within each asset class, you'll want to hold a variety of individual securities. For stocks, this could mean investing in large cap, mid cap, and small cap companies across different industries like technology, healthcare, consumer goods, and financials. This intra-asset class diversification can help smooth out the ups and downs of any one sector or market capitalization. For bonds, you may want to diversify by holding government, corporate, and municipal bonds of varying maturities. This can provide income stability from the government and high-quality corporate bonds, while municipal bonds offer the potential for tax-advantaged returns. You may also want to consider inflation-protected securities like TIPS to hedge against rising prices. It's also important to consider global diversification by investing in international markets, which can provide exposure to faster-growing economies and asset classes that may zig when the U.S. markets zag. Developed international markets like Europe and Japan offer mature, stable economies, while emerging markets in Asia, Latin America, and Eastern Europe can be a powerful source of long-term growth, though they also come with additional political and currency risks. Alternative asset classes like real estate, commodities, and cryptocurrencies can further diversify a portfolio, but you'll want to be cautious about over-allocating to these more speculative investments. Real estate, for example, can provide inflation protection and steady income through property rentals. Commodities like gold, oil, and agricultural products can also serve as a hedge against inflation. And cryptocurrencies, while highly volatile, may offer uncorrelated returns compared to traditional asset classes. The key when incorporating alternative assets is to understand how each one fits into your overall strategy and risk profile. They shouldn't make up the majority of your portfolio, but can play a complementary role in diversifying your holdings. As with any investment, it's crucial to do your research and only invest in what you fully comprehend. One final note on diversification: there can be such a thing as too much of a good thing. Overly complex portfolios with dozens of individual investments can become difficult to monitor and rebalance effectively. Strive for a diversified yet streamlined approach that aligns with your financial goals and risk tolerance. Rebalancing and risk management. To maintain your target asset allocation over time, it's crucial to rebalance your portfolio periodically, usually on an annual or semi-annual basis. This may involve selling assets that have appreciated and reinvesting the proceeds into underperforming asset classes to get back to your desired mix. Rebalancing helps you avoid letting your portfolio drift too far from your risk profile, and it also allows you to buy low and sell high, a cornerstone of successful long-term investing. Just be mindful of potential tax implications, especially in taxable investment accounts. For example, let's say your original 60/40 stocks bonds portfolio has shifted to 70/30 due to strong equity market performance. To rebalance, you'd sell enough of your stock holdings to bring the allocation back down to 60% and use those proceeds to purchase more bonds. This disciplined approach prevents your portfolio from becoming too aggressive over time. Rebalancing can also help you take advantage of market volatility. When stocks decline, rebalancing forces you to buy more at temporarily lower prices. Conversely, when stocks soar, rebalancing prompts you to sell some of those winners and reallocate to underperforming asset classes. Over the long run, this buy low, sell high mentality can enhance your overall returns. Finally, when building your portfolio, it's critical to understand your own risk tolerance and time horizon. Avoid investments you don't fully comprehend, and make sure your asset allocation aligns with your financial goals. Consulting a qualified financial advisor can also be immensely helpful in developing a personalized investment plan. In summary, constructing a diversified investment portfolio with thoughtful asset allocation is key to managing risk and positioning your investments for long-term growth. Remember to regularly rebalance, stay disciplined, and never invest in anything you don't fully understand. I hope this video has provided a solid foundation for building your own investment strategy. That's it for today's video on building an investment portfolio. Remember, everyone's financial situation and risk tolerance is different, so it's important to tailor your investment strategy to your own needs and goals. Thanks for watching, and don't forget to like, share, and subscribe for more financial tips.